Welcome to the Opening Bell Report.
27%.
It's a number that makes you double check your screen, isn't it? You assume the data feed is broken.
Exactly. I thought it was a typo. I thought, maybe I needed to refresh the page or restart my Wi-Fi. But no.
Not a glitch.
That is not a glitch in the matrix. That is exactly how much the Sprott Physical Silver Trust Ticker, PSLV, dropped in a single trading session this past Friday.
Friday, January 30th. It's barely been 48 hours, but in the precious metals forums, they're already calling it the Friday Massacre.
And for good reason. I mean, usually when we talk about a crash, what are we talking? 5%? Maybe 7% on a really bad day?
A really hideous day, yeah.
But looking at a chart that just gaps down almost $10 per share, that triggers something primal in your brain.
The lizard brain, the part that just says run.
It looks like a falling knife. It looks like a disaster.
It absolutely does. And for the average investor, or even a seasoned one, the natural reaction to seeing a vertical red line like that is just pure panic.
Get out. Sell everything.
Salvage what you can before it goes to zero. That's the instinct.
But, and this is the massive but that we're centering this whole deep dive on, we have a special situation report on the desk today.
Dated today, Sunday, February 1st, 2026.
And it's looking at that exact same chart, that same carnage, and it is coming to a completely different conclusion.
Right. The analysis we're diving into isn't asking how much money did we lose. It's asking the real question, is this a catastrophe?
Or is this the sale of the century?
That's the provocative part.
The title is literally Why I'm Buying the Blood in the Streets. So we know where they stand. But I want to be careful. We need to unpack why. Because the core thesis is fascinating.
It is.
They're arguing the price of the share crashed, but the silver, the actual metal in the vault, it didn't go anywhere.
Exactly. It's a classic discrepancy between price and value. The report calls it a liquidity event, not a fundamental collapse.
And that distinction is everything.
It's the difference between panic selling and, well, strategic buying.
Okay, well, who doesn't love a bargain? But before we start backing up the truck, we need to check the math.
Always check the math.
A 27% drop doesn't happen for no reason. So let's get into the anatomy of this crash. What actually happened on Friday?
So let's look at the mechanics. The stock closed Thursday at $36.29. Pretty normal. But Friday morning at the opening bell, it didn't just drift down.
No, it gapped down.
It gapped down hard. Opened at $30.65.
And for anyone not staring at charts all day, a gap down means there were literally no buyers at $35, $34, or $33.
Yeah.
It just skipped all those prices.
Precisely. It implies an immediate, overwhelming imbalance of sellers. The market makers just said, nope, nobody's home until $30.
Wow.
And it didn't stop there. The selling was relentless. It spiraled all the way down to a low of $24.05 before it finally found some footing.
So we're talking about an intraday range of what, $8 on a $30 stock? That is insane volatility.
We're talking 25% plus volatility. In a single session, that kind of move can take a decade in the bond market.
Now, the report talks about capitulation volume. I feel like analysts love that term because it sounds so dramatic. But what does it actually mean?
Capitulation it's when the market throws in the towel. It's not rational selling anymore.
It's emotional.
It's forced selling. It's not someone deciding, based on my analysis, $30 is too high. It's someone screaming, get me out at any price right now.
Forced how? Are we talking about algorithms just going haywire?
Sometimes, but with a move this deep, it's usually about leverage. This has all the hallmarks of funds getting margin called.
Okay, break that down. Give me the simple version of the margin call dynamic here, because I think that's key.
Sure. So imagine a hedge fund borrowed money to buy a ton of silver because they thought it was going to 50. They're leveraged maybe 2 to 1, 3 to 1.
Okay.
When the price gapped down Friday morning, the value of their collateral, the silver shares, just collapsed. So their broker's computer flashes red.
And it says you need more cash.
You need to deposit more cash now to cover this loan. And if they don't have it,
The broker sells for them.
the broker doesn't care about their thesis. The system just hits market sell. And since everyone's getting the same call at the same time,
It becomes a cascade.
a feedback loop. They sell into a falling market, which drives the price down more, which triggers more margin calls for other funds.
So the argument is that the people selling on Friday weren't selling because they wanted to, or because they suddenly hated silver.
But because they had to, it's mechanical. And historically, when you see that kind of capitulation, it often marks a local bottom.
Because everyone who's going to panic is now out.
Ugh.
The weak hands are gone.
There's no one left to sell.
Okay, so the sellers are washed out. That sets the stage. But just because it stopped going down doesn't mean it's a buy. This brings it to the core of this analysis, the NAV arbitrage.
This is the most important part. If you get one thing from this deep dive, it's this. This is the engine of the opportunity.
The report uses this great analogy. It says, this is like buying silver dollars for 90 cents.
It's a perfect analogy. But to get why it's possible, you have to understand that PSLV is a closed-end trust.
Which is different from a regular stock and different from a normal ETF like SLV.
Very different. Think of a standard ETS, like one for the S&P 500. They're open-ended. If lots of people buy, the fund just creates new shares and buys more stock.
Right, so the price of the ETF always matches the value of the stuff inside it.
Exactly. It's designed to track perfectly. But PSLV is closed-end. It has a fixed number of shares out there. It doesn't just create or destroy them on a whim.
So if everyone panics and sells their shares all at once,
the share price can crash independently of the silver price.
Okay, so let's put numbers on it. Friday, the spot price of silver itself.
Yeah.
It did fall. It was down, what, 15 to 20%?
It did. It was a bad day for the metal, no doubt. But remember, PSLV shares fell 27%.
I see it. There's the gap. The paper share price fell way more than the actual pile of silver it represents.
Exactly. A mathematical gap opened up. The analysis estimates that right now, PSLV is trading at a 9 to 12% discount to its net asset value, or NAV.
So if I buy a share of PSLV at, say, $26.41,
you are buying a claim on real silver sitting in the Royal Canadian Mint, but you're getting it at a huge markdown compared to the spot market.
it's even better because normally you pay a premium over spot for physical metal.
That's the crazy part. Here, you're paying a discount under spot.
That is the definition of arbitrage. You're buying fully allocated silver for less than it's worth on the open market.
And the thesis is that gap has to close. The panic will fade, and the share price will have to realign with the metal price. That 9 to 12% is free upside.
It's like finding a $100 bill on sale for $90. You buy it just because you know the pricing error will fix itself.
And in this case, if the spot price of silver also recovers, you win twice.
We'll get to the strategy in a minute. I want to point out another weird number in this report, the PE ratio.
Yeah, that's an interesting one.
How does a pile of metal have a PE ratio? It doesn't have earnings. It doesn't sell anything.
It's a bit of a reporting quirk, but it's a useful measure of value. The report highlights that the trailing PE ratio for PSLV is now 4.99x.
Which sounds incredibly low. I mean, we're used to seeing tech stocks at 50, 100 times earnings.
Easily. A PE of 50 means you're paying $50 for every $1 of earnings. Here, the earnings are basically the asset appreciation.
So a PE of under 5 means you're paying about $5 for every $1 of value it generated recently.
In the world of hard assets, anything sub 5 is considered deep, deep value territory. It's just another indicator that's screaming oversold.
Okay, so the market is just wrong. The price is lying about the value.
Yeah.
But why PSLV specifically? Why not just buy SLV, the iShares Silver Trust? That's the big one.
And that's a crucial distinction for this specific trade. SLV is fine for tracking silver day to day, but for this opportunity, PSLV is unique.
Let's break it down. PSLV versus SLV.
Okay, first, asset backing. PSLV is fully allocated physical bullion. The hard money crowd loves it. SLV is more of a basket of custodian-held silver. Some criticize it as paper derivatives.
So PSLV is for the purists.
Yes, but more importantly for this trade is the price behavior. Remember that arbitrage we talked about?
Right.
SLV tracks spot very closely because big banks can arbitrage it instantly. If SLV deviates, they step in and close the gap in seconds. You rarely see a discount.
So you never get this silver for 90 cents deal on SLV.
Almost never. It's designed not to break. PSLD, because it's closed-end, can break away from its NAV. And the fact that it broke is the opportunity. The breakage is the trade.
So if you bought SLV on Friday, you just bought silver. If you bought PSLV, you bought silver at a discount.
That's the key. You're getting more ounces for your dollar.
All right, let's play devil's advocate. I'm a skeptical listener. We're talking about buying something that just cratered. Catching a falling knife is dangerous.
It can be.
What if PSLV goes bankrupt? What if this whole thing just implodes?
That's the ultimate fear, right? Is this going to zero? But let's look at the balance sheet. The report calls it pristine.
How so?
Zero debt. This isn't a company burning cash. It holds metal. It doesn't owe anyone anything. It can't default on a loan it doesn't have.
Okay, that's a big one.
And unlike a company that needs cash flow to survive, PSLV just sits there. The only cost is a tiny management fee, about 0.5% annually.
Which is nothing compared to a potential 12% discount.
It's negligible. The point is, PSLV cannot go bankrupt unless the price of silver itself goes to zero.
And if silver is at zero, we have much, much bigger problems.
We're probably trading canned beans at that point, yeah.
Okay, so solvency risk is low. What about the technicals? Could it just keep falling?
It could. Silver is volatile. But the technical setup is screaming oversold. The report points to the RSI, the Relative Strength Index.
Translate that for us.
It's like a rubber band. You stretch it too far, too fast, it has to snap back. Anything below 30 is considered oversold. PSLV's RSI is likely below 20 right now.
Which is rare.
It's a statistical anomaly. It means the selling has been so intense, it's unsustainable. The sellers are exhausted.
And then there's the gap fill, We talk about that huge gap at the open.
Right. That vacuum on the chart between roughly $36 and $30, market mechanics often force prices to rise back up to fill that vacuum once the panic is over.
And it did seem to find a floor, right? It didn't close at the absolute low.
It did. It stabilized around $26. That suggests the smart money, the institutions who understand the NAV, started stepping in to defend that level. They're the ones buying.
Okay, so let's talk strategy. The report says strong buy. How exactly does a person win here?
It outlines a dual upside. Two engines working for you.
Engine number one.
Spot price recovery. Silver crashes, but it also snaps back. If silver rebounds, PSLV goes up. Simple.
Standard play. Betting on the metal.
But engine number two is the kicker. Discount closure. Even if silver prices stay flat, let's say silver doesn't move a penny, if the panic just stops and the shares go from trading at a 12% discount back to NAV,
The share price goes up.
the share price goes up because the gap closes, so you have two ways to win.
And that leads to the price targets. The base case in the report is a move back to the 50-day moving average. That's a target of what, $32?
$32 or higher.
From $26.41 to $32. That's a potential 21% upside, just by going back to normal.
Not by going to the moon, not by hyperinflation, just by things getting back to normal.
And what about the downside? What if we're wrong and silver drops another 10%?
This is where that arbitrage protects you. The discount acts as a cushion. If silver drops another 10% because you bought at a discount, you have a buffer.
So the metal price falls, but my share price might stay flat because the discount tightens at the same time.
They can cancel each other out to some degree. You've got asymmetric risk reward, more ways to win, and the ways you lose are cushioned.
Okay, let's synthesize this. The market saw a crash. It saw red arrows. It panicked. But this analysis is saying, wait a minute.
It's the voila moment. The market is pricing PSLV as if the silver in the vaults just vanished.
But it didn't.
It hasn't. The metal is still there. The crash was emotional, not fundamental.
And that's where the opportunity is. You're buying other people's fear.
Be greedy when others are fearful. This is the textbook definition of that.
And there's this final thought in the report that I think is really powerful. It frames this trade not just as a stock, but as insurance.
Yes. This is the big picture. People hold silver as a hedge against currency debasement, inflation, all that. By buying PSLV now, you're buying that insurance.
But usually you pay a premium for insurance.
Exactly. But here, you're getting that insurance at a markdown. You're buying a policy from someone who is panicking and selling it to you for less than it's worth.
That really reframes it. You're not catching a falling knife. You're picking up an insurance policy someone dropped on the floor.
That's the best way to put it. It's a chance to get a hard asset at a paper discount. And in this world, that's a very comfortable place to be.
Well, this has definitely been an eye-opener. It's easy to get swept up in the fear, but sometimes that's exactly when you need to look at what's actually inside the box.
Always check the vault. Price is what you pay. Value is what you get.
Couldn't have said it better. As always, don't just take our word for it. Look at the numbers, check the NAV yourself, and decide if this is a falling knife or a silver opportunity. Thanks for diving in.
My pleasure. Stay curious.
Don't forget to like, share, and subscribe for more.